Alright traders, welcome back to the channel. Today we're breaking down one of the most misunderstood, yet most profitable, concepts in smart money trading. Fair value gaps. We'll go deep into how FVGs actually work, why they act like magnets for price, and then we'll take it a step further and unlock the advanced side of the game. Reversal fair value gap, and how to build a trading plan around them. By the end of this video you won't just understand FVGs. You'll know exactly how to use them to anticipate where the market is likely to go next. Let's dive in. Alright, let's nail down exactly what a fair value gap is. A fair value gap forms when price moves so aggressively, usually on news, a big player entering, or liquidity being swept, that the market skips an entire price zone with almost no trading activity in it. The textbook definition most ICT traders use is this. Look at any 3 consecutive candles. If the low of the first candle is higher than the high of the third candle, that's a bearish FVG, price gap down. If the high of the first candle is lower than the low of the third candle, that's a bullish FVG, price gapped up. The actual gap, the fair value gap itself. Visually, you'll usually see a big momentum candle in the middle, with almost no overlap between the first and third candle bodies. That's your inefficiency. But have you ever noticed how price keeps revisiting these zones over and over again? But why? Okay, let's talk about why these gaps actually work in the real world, not just pretty boxes on a chart. There are 2 main forces that make price respect FVGs like clockwork. First, liquidity. That empty zone wasn't traded fairly, so there are almost always resting orders sitting inside it. If you zoom in on the chart, this gap is actually the result of a strong move. And it contains stop losses above and below old lows or highs, pending buy or sell limits from breakout traders, and take profits from the previous move. All of that combines into a giant liquidity pool. Second, smart money loves free liquidity. They'll often route price right back into that gap to take those orders out, buying or selling at the best possible price, before the real directional move continues. Third, market efficiency and algorithmic logic hate imbalances. Their job is to keep the market fair. When a gap forms, it registers as an inefficiency that needs correction. Until it's at least partially filled, the market is technically in a non-equilibrium state. Here's something most traders never even notice. Every single FVG has 3 critical zones. And misunderstanding these is exactly why most people lose money on so-called FVG setups. First, the premium zone. This is the expensive side of the gap. For a bullish FVG, it's the upper boundary. For a bearish FVG, it's the lower boundary. Think of it like a magnet. At first, price loves coming here, but beware, it's also the most dangerous spot. Rejections happen here all the time. Second, the discount zone. This is the cheap side of the gap. For a bullish FVG, it's the lower boundary. For a bearish FVG, it's the upper boundary. This is where smart money actually wants to enter, buying low, selling high. Third, the midpoint, also called 50% equilibrium or consequent encroachment. This is the sweet spot. Here's what the numbers say, real stats from funded ICT traders in 2024 and 2025. 70 to 80% of high probability setups trigger from the midpoint, or slightly into the discount side. touching only the premium of a bullish FVG. Expect rejection 80% of the time. Closing beyond the discount? That FVG is fully mitigated, the bullish bias is dead or at least paused. The golden rule in 2025. Only take trades when price returns to the discount to midpoint zone of a valid, unmitigated FVG, aligned with the higher timeframe trend, confirmed by displacement and order block confluence. Do that, and you're no longer hoping. You're executing like the banks. But in an impulse move, there can be multiple FVGs. So which one is the real entry point? Alright, this is where most traders' brains explode, and where the real money is made. Here's how it plays out. Price is trending and leaves a clean FVG behind, bullish or bearish. Later, price hits a major key level, could be an old high or low, an order block, a FVG or liquidity pool. At that point, the market decides the old plan is dead. Instead of respecting the original FVG, we see a strong, aggressive move that slices right through the gap and closes beyond the opposite boundary. The moment that candle closes past the far side of the FVG, the inversion is complete. That zone instantly flips polarity. So, a normal FVG? It's like a magnet. It pulls price back in to fill the inefficiency, right? But the reversal fair value gap flips the whole idea. The market basically says, we're done filling this gap the usual way, now we're flipping the script entirely. Now here's a real chart example. Price rallies aggressively, leaving multiple bearish FVGs behind. Later on, price taps into a FVG. And as smart traders, we don't chase. We wait for the reversal FVG to appear. And here it is. That impulse breaks structure and forms a clean CHoCH, a signal the market is ready to reverse. From here, patience is everything. We wait for the price to retest that reversal FVG. And once we see rejection from that zone, that's our entry. In real trading, you can combine this with multi-timeframe analysis to make the setup even more powerful. Here's an example. On the 4-hour timeframe, you can see a clean bullish FVG. That's the zone you expect price to come back to. Now drop down to the 1-hour timeframe. Watch closely. You'll see an impulse that breaks this level and forms a CHoCH signal. That tells you the market is shifting. From here, you wait for price to return and react to the reversal FVG created by that impulse. And that is your entry point. So now you've learned what an FVG is, the logic behind it, and how do we wait for the reversal FVG to get a cleaner, high-probability entry. Train your eyes to spot this setup, and you'll start seeing the exact moment the trend changes hands. Thanks for watching. If you found this helpful, hit subscribe, drop a comment about your experience with FVGs, and don't forget to like the video. I'd love to hear how you're applying these concepts in your own trading journey.